Okay. Hi, everyone. It is March 24, 2023, and you're watching the Awesome 10X, or me, Nikki Yu, also known as Faces Trader on Twitter. And we're going to be discussing today commercial real estate loan exposures and banking crisis. Listen up. Of course, every Friday is a free Friday class, and we hope for everyone who wants to learn from us on a daily basis to subscribe to awesome10x.com for more in-depth reports and real-time market data all throughout the markets if ever you prefer to learn with us. All right, so let's begin for today's class. Wait up. I'll just share my entire screen, guys. Okay. Let me see if you can see what I am doing. Yep. All right. Just trying to ensure that you are seeing it. All right. So let's begin. Commercial real estate loan exposures and banking crisis, March 24, 2023. So we do believe that the events that have already unfolded will continue to accelerate the banking crisis that has begun to open since the Silicon Valley Bank collapse, Signature Bank New York collapse, Credit Suisse, Silvergate Capital, and more are just the Pandora's box to more events that will accelerate into collapse. Now, this data is a data point that we want you to learn about. As of December 2020, the largest US banks in terms of commercial real estate loan holdings, the first is Wells Fargo, the second is JP Morgan, the third is Bank of America, the fourth is US Bank Corp, the fifth is PNC Financial Services Group, sixth is Truist Financial Corp, Citizens Financial Group, Capital One Financial Corp, Regions Financial Corp, and Fifth Third Bank Corp. It is important to note that the next ticking time bomb, other than the treasury bond market that is failing due to high interest rates, is commercial real estate loans. They're actually mortgage backed and is actually posing significant drawdowns already. And it's having actually a big drop. So KRE, which is the regional bank, puts, even if it's already a consensus that the regional banks will fail, we do believe that the KRE puts will continue to print money. This is a table that shows to you that the total CRE loans to the overall business loans today is roughly in the 50% region. CRE loans are making up a significant fraction of overall business lending, mostly concentrated in the smaller banks. As you can see from the tables here, small banks are the largest, medium-sized banks, and the large banks. As the small banks implode, you will see the CRE loan exposures become a huge bomb that could explode. Okay, small banks, medium-sized banks, large banks. Who's gonna seize these $3.5 trillion worth of CRE loans that's currently in the market? Now, Andreas Tino Larsen also shared this table. I'd like to share some of these for you. Note that the huge exposures to commercial real estate are mainly found in regional banks, meaning from a percentage of total assets, these are the ones to watch now. Full list here. So he actually shared that Valley National Bank Corp, with current total assets of about 57 billion, has a held to maturity over total assets here and a commercial RE loan book of about 29 billion, which means that Valley National Bank Corp actually has 50% of real estate loan exposure towards total assets. So previously, we were already discussing that the treasury bond market is already creating havoc in the capital flight as people keep on withdrawing their deposits. Another thing to note from regional banking collapse redux is actually the following. You've got Valley National Bank Corp, Home Bank Shares, Glacier Bank Corp. These are all forming 37, 39%, 51%. Let's read further. Signature Bank New York was already seized up by the FDIC. You've got East West Bank Corp here. You've got Webster Financial Corp, First Citizens Bank Shares, M&T Bank. M&T Bank actually managed their loan book portfolio. Well, their their treasury bonds, but you could see that they also have a 22% exposure in the commercial real estate loans market. So right now we're just seeing their RE loans exposure. Did they get to refinance this at a higher interest rate, or was this locked at a fixed interest rate? Meaning, are majority of the residential owners paying them uh, a small interest rate versus the equity, which is the collateral will be the home. Okay, so these are actually those at risk, and you can see that most of them are in the regional banking sector. So a few things to share here. This is VLY, Valley National Bank Corp. Looking at the chart, it already has been dropping and is actually hitting new lows in terms of the 3-year chart. But in terms of like the last 7 years, it's actually currently at the 7-year low, with only the 2020 lows, the next support at 7. So critical that many funds continue to short these regional banks, and we believe that there will be an acceleration to the downside for these banks. Home bank shares is also trading currently at the 3-year lows, in the 2021 lows here at $21, but we expect that these trends will follow further to the downside, perhaps hitting either 15 or 10. Glacier Bancorp, this is the monthly chart. 60 is already trading below 40s. Could it hit 30 or could it hit 20? Something to watch for Glacier Bancorp. Now, take note that Carl Icahn, a legendary hedge fund manager, his biggest short position is actually commercial real estate. He actually built this position for 3 years straight since 2019, 2020 even. And he shorted commercial real estate. It has to be known that he did this even before the COVID lockdowns, as he noticed bubbles in the commercial mortgage bond market. So take note that even before COVID lockdowns, even before a remote work secular trend, the commercial real estate loans were already at a bubble. And this only solidified when nowadays, obviously, there's 50% vacancy, ghost offices and ghost malls, brought about not by COVID lockdowns, but the actual remote work. Due to people working from home, there have been less and less people in the offices, which actually solidified that 50% vacancy ghost office. So he said actually that his biggest short, and this is March 2020, by the way, this is before the COVID lockdown. It was like selling insurance to somebody who's gonna go to the electric chair. It means that he knows that this sector is gonna die. And you can see that even in earlier, even before the COVID impact, because he was already buying a lot of the CDS or credit default swaps. Basically, he's getting an insurance that if the malls were to default, he'll get paid. So the boost to the big short, and of course, those ended up very, very much correct. A few things to note. This is your XLF. XLF is currently trading at the 1-year lows here, below the October, below the May, and we expect this to break down and accelerate to the downside, perhaps hitting near these 2020 lows towards the 22-23 area. While we cannot expect this to happen within the next week or the next 2 weeks, we do believe that there will be further pain ahead, and we would caution anyone who actually thinks that the financial crisis is over with these bank term financing program or these bailouts or these assurances by the government. We do not expect that to be so. This is the regional banking crisis as well. This is the KRE, the ETF. Although it has fallen from $60 to $42, we do think that it is now about to break these or retest the 2020 COVID lows, at least for the next 3 to 6 months. This is the KRE. Now, all the financial bulls are going to be breaking down in our view. So 90 has already dropped to 50. We expect that to further drop further at 40 to 20s in the next coming months. So any financial bulls are expected to continue to fall and fall and fall further. This means that for those who prefer buying inverse funds, the financial bears, aka the FAS, would be a buy the dip mentality. So this means that anyone still buying FAZ, for those who got in at $16 here and those who are adding further at 22 or 24, we do expect this to hit near 30 and possibly near higher highs, as the deepening, worsening crisis will continue in the next 6 months, even if the Fed pauses, as these stresses in the banking sector are not gonna get solved at the moment. It's not gonna get solved even for the next 6 months to a year. So we also believe that this crisis will not end until JP Morgan goes below $100. We believe that the CRE loan exposure will not just be detrimental for the small regional banks, but also for the top four. So we're seeing that JP Morgan 145 has already dropped towards 126, just a 15%, about 10 to 15% drop. Think that it can fall furthermore, breaking these supports of the last 5 years of 107. So we see this falling further here. Now, we also agree with all the other bank bears. This is not going to be finished until the banks decline to year 2020 COVID lows. These trends will accelerate and the shorts will continue to short the banks. They will continue to sell financials. We believe that Bank of America will continue falling towards 20 due to the uncertainty or the inability to recapitalize substantial portions of their current positions. Bank of America, Wells Fargo, these, even JP Morgan, these banks have huge commercial real estate loans. And if they actually lent money, let's say they used to think that this building is worth $100 million and they took a collateral of that, but unlikely for that building to actually fetch $100 million. Let's say with higher interest rates, it's just $65 million. That means that even if they someday have an illiquid loan, if that bank, if the bank actually had to seize up that real estate, whether it be a mall or an office building, chances are that the banks will incur a huge unrealized loss on them, and this will become an illiquid asset in the realm similar to the housing crisis, but in this case more on the commercial real estate. Now, it must be known that regionals are most exposed, but as we said, large banks are not going to be immune. Hence, we believe that all banks in the future will get downgraded even further. So downgraded ratings for the entire financial sector means that anyone who's buying FAZ or financial bears will continue to print money if you have an outlook somewhere in the zone of 3 months to 6 months and so on. So let's take a look further. This is Bank of America. We take note that Bank of America is actually Warren Buffett's largest bank position. And so we have a huge short as well on Berkshire Hathaway. We think that Warren Buffett, the Oracle of Omaha, is not immune to the financial stresses and collapses. Take note the following things. Let me show you the chart of Warren Buffett here. So he is, in our view, going to go down the ship. He has, unless of course we realize that he has covered calls, if he's selling positions on his own shares. We haven't seen if Mr. Warren Buffett has been selling calls on his Bank of America. We do note that he has 1 billion shares of Bank of America, and unless we are seeing if he is selling calls on it. So far, the financials as of the year end 2022 says that Warren Buffett owns Bank of America, $34 billion worth, Bank of New York Mellon, $1 billion of that, Citigroup, $2.5 billion, Globe Life, he owns $766 million, Jefferies Financial Group, $15 million. We have to note that he did sell his U.S. Bancorp, but it's still a largest exposure actually that Warren Buffett has in the financial sector is rotten Bank of America. Okay, let's show you further a few things here. Wait up. Let's talk about the stresses in the sector. Okay, so it's very clear here that you can see a Bank of America actually recently tried to recapitalize at about $29 and failed to do so. We think that there will be further dilution happening to all the Bank of America shareholders such that it could actually hit this 19 area which is like 2020 COVID lows. So be aware that Bank of America has huge stresses, not necessarily in the treasury bond market, but in the commercial real estate loan sector. As real estate loans to domestic offices in a percentage of loan type, let's take a look at this. You can see that FRC, First Republic Bank, a small bank, is actually getting hit and has had to be recapitalized by JP Morgan and all the rest of the banks. As commercial real estate continues to crash, all US financials today have a high probability failure, hence acceleration to the downside of XLF, even if a merger and consolidation would take place. This means all the banks here are are treated as one sector problem. Let's read this. First Republic Bank, Flagstar Bank, Valley National Bank. These are all 60% loan exposures to commercial real estate loans, construction and land development real estate loans, multi-family residential real estate loans, and 1 to 4 family residential real estate loans as a share of assets. So these, if you want to check out the biggest regional banks that have huge problems, let's read it to you again. First Republic Bank, Flagstar Bank, Valley National Bank, East West Bank, Western Alliance Bank, Synovus Bank, First Horizon Bank, Webster Bank National, MUFG, Union Bank, City National Bank, First Citizens Bank, and Truist Company Financial, Zions Bank, Manufacturers and Traders Trust Company, Citizens Bank, Signature Bank, Bank of the West. So at least like Huntington Bank. I mean, these banks all basically have huge exposures, whether you're looking at the 40% to 60% exposure and above. Now, the banking industry's exposure is currently at about $5.5 trillion. And that is a huge ticking time bomb, given that the US money market funds today in the treasury bills is just $5 trillion today. So there's actually a lot of loans here that are going to end up, even if you just assume a 20% hit, a 20% write-off, it's going to cost about $1 trillion to the entire marketplace. Now, we did note that small banks own the lion's share, so KRE shorts continues to pile up despite any intervention by the Fed. You can see that in the residential real estate loans, this is the big banks and this is the small banks. However, in the commercial real estate, this is the big bank exposure and this is the small bank exposure. So the stock of CNI loans in the US from big and small banks can see that this big banks, small banks, consumer loans, big banks, small banks. So commercial real estate exposure is the thing about small banks or regional banks is that they are not really small in aggregate, as they actually dwarf the large banks when it comes to commercial real estate lending. So this is a difficult trade-off facing the US today between protecting uninsured depositors at small banks versus a potentially deep credit crunch. Okay, you can see small domestic chartered banks actually own 70% of all the CRE outstanding loans. That's a huge amount since January 2023. Now, let's take a look at a few of the REITs that are currently happening at the moment. You can see that all of them are declining to new lows. BXP, Boston Properties, Vornado Realty Trust, SLG, all hitting new lows. Recent Fed stress tests of the big banks are projecting $75 billion of losses at a 10% stressed loss rate. Banks own half to the $3.5 trillion in just the commercial property debt market. So you're seeing that maybe in the next few quarters that the credit loss provision may be larger than expected for the entire banks. Like JP Morgan, of course, will report on April 14, which we think will actually be a surprise sell-off that will trigger further losses in the market. CRE collapse, the commercial real estate collapse or surprises to the downside is actually approximated with a regional bank collapse and a big bank's collapse. This is something to watch out for. And we're actually looking at also some anecdotes. Other people are confirming that those who are working in a bank as a credit analyst, they have been worried about these CRE loans Ever since 2018 to 2020, even before the COVID lockdowns, they have been ballooning, obviously. And now with higher interest rates going up, the collateral value is actually coming down. As you can see, if it was divided by 1.03 and now it's divided by 1.08, for instance, then you can see that that collateral is definitely lower in value. You now see how ugly this situation gets if payments start to get missed due to increased vacancies at the CRE property. The banks can become upside down on these loans really quick. So the Fed might be aware of this. That's why the higher they raise rates, though, the bigger issue it becomes. So rendering the further problems, take note that remote work has already rendered almost all commercial office real estate industry to a 50% vacancy. And all of these loans in CRE are actually underwater. There will be a solution, of course, which is just let the CRE buildings crash in prices and collateral value. The banks will own all the cheap office buildings, but that also means that those collateral now sequestered by all the banks will also suffer an insurmountable default or loan-related losses. So we would see their NPLs or net provision losses for these types of loans also escalate. Now, let's assume that $3.5 trillion of CRE drops 30%. That means $1 trillion of losses for the entire banking sector, whoever bank it would be, which I doubt is enough collateral for them. So commercial office buildings bubble will only heal with a major crash. There has been a lot of news about this commercial property debt creating more bank worries. Wall Street Journal talks about an 80% of commercial mortgages held by all the banks, 2 trillion held by small banks. These are your REIT offices. They are falling haywire. Alexandria Real Estate, Boston Properties, Kilroy, Vornado. I just showed you a while ago all the charts of these. They're all continuing downwards to new lows. These are the charts, new lows, new lows, new lows. All of them new lows from the big ones to the small ones. Take note that if office REITs crash, it is also normal to assume that all the real estate service companies like CBRE and Jones Lang LaSalle, they would also crash and they will continue to fall since no tenants equals no property management fees. So Jones Lang LaSalle has already fallen from 280 to 140. We expect that to fall further, just like in the COVID lows here of about $80, likely to hit that anytime soon within the next few months. This Jones Lang LaSalle on a daily chart hitting new lows. We think that will continue and accelerate downside even further. This is your CBRE monthly chart from 110 to about 70. We think this can go further halfway down towards 40 in the next coming months. CBRE, no tenants equals no property management fees. So also on the daily, you can see that CBRE is looking to hit new lows in the next 3 to 6 months. Tapestry, we're looking to short all the apparel retail. We believe that as office REITs, as consumption continues to crater, we think that all the apparel retail clothing, we are short on Foot Locker, we are short on Burlington stores, Nike, we're short Tapestry, we're shorting, we're basically shorting Capri. If we could set a short on Capri Holdings at about $50 above. But in general, most of these apparel and retail is a short. And with retail spending going down, therefore all your malls would have lesser sales. Therefore, the tenants on the malls would have a problem in rental expenses. So all these mall REITs are also gonna further fall. So generally, even the malls, department stores in US will suffer declines due to possible vacant tenants or lower rentals. So when a business fails to secure loans, example, let's say Foot Locker closing a lot of stores. They're talking about closing 400 stores. Let's say Nike, Burlington stores, they further close down some of their not in demand types of storefronts. Due to lower sales, they'll do that, cost efficiency. We believe that the mall operators will continue to suffer Therefore, all the malls and retail REITs will get affected with vacant or lower yields. So they have lower revenues and higher interest rate expenses, and that would mean lower income, and therefore, eventually, the share prices should be falling. So the large ones in the mall REITs or the retail REITs are O Realty, Simon Property Group, Kimco Realty, but you can actually assume that all of them are actually going to have failures in the next couple of months. So this is your Realty Income Corporation. I think that this is actually a short in the making. 70 could potentially go back to the new lows here of COVID. Simon Property Group, big shorts also for this one, 140, 120, $100, looking to see it hit near 40s or 60s in the next coming months. If the shoppers have no money, that means all the renters, basically shoe apparel tenants, will not be able to stay. Either they will close down and hence go smalls too. Just recently, we saw Foot Locker close 400 stores. That's their plan. That's just one company. We expect more companies to close down more stores, whether it be Abercrombie and Fitch, Ralph Lauren, Tapestry, Gap, Under Armour, and so on. So we actually expect almost all retail outlets to start closing or downsizing within the next few quarters and laying off more people. So this is the chart of a mall retail operator, Kimco. So we think that this 25 dropping to 17 is not over. Further downside ahead towards 10 or 12 in the next coming months. Kim Mall REITs. So we generally believe that offices and malls are cyclical in nature. Recessions don't mean that they will continue to have companies paying them high recurring rentals. Also, vacancies are higher during recessions due to lower sales. So some of the mortgage finance companies, we also have a short idea. PennyMac Financial Services, we believe this is a short in the making, 70 and 55. This is a company that is one of its largest businesses is obviously to provide U.S. mortgage loans, third largest mortgage lender, sixth largest mortgage servicer, and largest aggregator of residential mortgage loans in the U.S. So it is a consumer direct model. And in its Wikipedia, it says here that PennyMac in 2019 surpassed $1 billion in revenue for the first time, $118 billion in unpaid principal balance. Now, this actually doubled towards $370 billion in unpaid prepaid principal balances in 2020, mainly attributable to low interest rates from the Fed government's efforts to fight the economic impact of the COVID-19 pandemic. In 2020 alone, PennyMac saw the loan origination value surpass $36 billion across over 117,000 mortgages, making them the 15th largest mortgage lender. Says here that PennyMac conducts business in three segments: mortgage production, mortgage servicing, and investment management. In the PennyMac, they actually originate loans from small banks and independent originators. Now, retail lending will originate new prime credit quality, broker direct lending. We believe that these types of loans are actually risky in nature. And take note that PennyMac was actually acquired in 2008 by Bank of America, BAC. This was a deal widely viewed as a forced marriage prompted by regulators during year 2008. Now, another thing to actually watch is Mr. Cooper Group. Mr. Cooper Group is a mortgage finance firm again. And in their website, they are sharing that they have 4 million customers. They've got $870 billion of servicing portfolio in unpaid principal balance. Should any delinquency happen due to high interest rates, they are going to probably suffer some losses in the future. They're the largest non-bank servicer in the US, the third largest servicer in the US, top 20 originator in the US, with $18 billion in total home sales through auction, originating $3.2 billion in loans. This is Mr. Cooper Group. Looks like this is a huge distribution from $45 to $40. Looks like it's going to fall back towards these 2020 lows near $5. Take a look at Mr. Cooper for shorts. Now, we actually checked out Bank of America. Bank of America loans or home loans was actually the mortgage unit. And this mortgage unit was done while it was purchasing the failed Countrywide Financial. So Countrywide in year 2006 financed 20% of all mortgages in the USA. Take note that Countrywide was actually criticized because you'll notice that this was completely the same executives who ran Countrywide Financial to the brink of bankruptcy in year 2008. So PennyMac and Countrywide Financial executives are the same group, and Bank of America had to bail them out as a forced marriage by the Fed after week-longs of bank runs. So we do believe that this bank run will repeat and is repeating. And in 2008, Countrywide Financial, then the largest mortgage lender in homes, had to be purchased by Bank of America, and the problems of Bank of America is repeating yet again today. Take note that PennyMac Mortgage Investment Trust, their REIT, is also collapsing from 20 to 11, showing that the market's public perception of these mortgage REITs are rotten and could continue to fall within the next coming months, years. Now, I'm not saying that Bank of America will go to $3, but you can see that Berkshire Hathaway has huge exposure in Bank of America. And, if this suddenly fails from $30 to $15 or $10, I'm telling you that Mr. Warren Buffett, if he does not have covered calls or puts on Bank of America, he might actually end up losing a ton for Berkshire Hathaway shareholders. This is a double top, as you can see, after how many years? 2008 to about 2022. And not saying that it's going to quickly go to $3, but there are some huge risks happening inside Bank of America. Take note also that these loans have been supported by BlackRock. And we believe that BlackRock here at about 650 with large, massive insiders selling here at 700 above has huge leeway to also drop 30, 40, 50%, either below 500 or even at 300 to 250. Careful on asset management firms, even like BlackRock, who's been helping finance almost all of these loans as well. So even on a daily, BlackRock has shown multiple top signals here at 800 and is continually falling. We think the first support is 500, although that will probably break further down towards 400, 300, or 250. Now, PennyMac, you can read it further. Critics of PennyMac have argued that this group of people have already contributed to lending practices that were questionable and thus shared blame for the subprime mortgage crisis. Although Kurland, then the CEO of Countrywide, the former president of Countrywide Financial, acknowledged his role in pushing for high-risk lending practices at Countrywide and regretted the turn of events, he actually still ended up being a founder for PennyMac. So could it be that history repeats itself, that PennyMac would again need some saving? So look at just the 2020, wherein they grew their loan books furthermore during the COVID. So they doubled their annual sales revenues in 2020 due to COVID, due to low interest rates sparked by government, which isn't true today. So this is coming from the website of PennyMac. Get the best of both worlds: a home equity loan, turn your home equity to cash, keep the rates on your existing mortgages. Mortgage rates so far are headed upwards. And as rate rise and homes are sitting on the market longer, there is this seemingly inescapable pressure cooker on prices, and it will have to have some of that steam let out of it. Either those home prices collapse, and when they collapse, somebody's going to either take a huge loss. Is it the banks? Is it the mortgage financing companies? And so on. So these are the customers. These are their billions of loans serviced. You can see that somebody's going to end up picking up the tab. Some people were saying that I have balls shorting Buffett. I don't think so. I just simply think that there is common sense that Buffett owns financials. Berkshire Hathaway has tons of rotten financials in their portfolio, and they'll be going down with it. Therefore, we have a Berkshire bearish spread puts here. And we think it's going to fall down to about $280. And then if it breaks 280 or 260s, then it's 220s. Okay. So that's just a quick wrap. I didn't think that I will be very, very fast in my banking crisis, but definitely we have a ton of short ideas. That's just a few. And actually, it was a part of our ugly zeros short list, which we were actually doing since March. So wanted to share to you that actually we had this class that we shared in the past. This was our title seminar. Wait up, are you still there? Yeah, so I'm not sure if you can see this, but in March 18 and March 20, 2021, we actually shared the nightmare on Wall Street and how to profit from a market crash and a potential peak in 2021. And we actually shared here the SPACs going down. And some of our short ideas was actually to short office REITs. They're actually going to be ghost offices, a bloodbath awaiting all the commercial property investors, empty office buildings, wave of COVID-19 bankruptcies beginning. So our thesis was pretty simple. Our thesis was the shift to remote work is eventually going to end up being the death of office properties. At that point in time, we were not yet forecasting higher interest rates. It was simply a matter of leverage on the office stocks and of course the vacancy problem. We also were thinking that the retail apocalypse would lead to default for commercial properties. So our shorts then were BXP, Boston Properties, Alexandria Real Estate, and SLG, the short office REITs. Actually, we explained that the reason why we were also doing it was also to short hotels. So hotels would be the hotel REITs, Real Estate Investment Trust. Then yeah, so e-commerce would drive malls to death. Shift to remote work will drive offices to death, and the shift to Airbnb or cheaper alternatives will be death to traditional hotels with leverage, just in case those are with leverage. So multifamily office landlords, we agreed with these assessments that the worst is yet to come, that we were in a giant bubble, and people would deny until they will accept. We think that we are currently in the not sure if we are in the acceptance. I think right now we're still in the anger or bargaining stage in terms of stages of grief. Yeah. So yeah. So this is Boston Properties. During March 17, 2021, we were looking to short it about 100 to 125. We thought that would be a gap fill. So far, BXP is currently already dropping towards 47. And yeah, so this was it. So this was the exact top 130. So this was we were thinking that it would be a short at 100, and then it rallied further to 122, further rallied to 130, and then it fell all the way down now towards new lows. So yeah, so we're seeing a lot of these not necessarily property defaults, but basically the banks are going to be huge trouble with these types of defaults. Okay. Hi, are we gonna go into recession this year? Highly likely that is gonna be happening this year. Yes. So recessionary playbooks are in play for entire portfolios in our view. Yes. So part of our ugly shorts are actually this one. We published this March 2021. We said to short Jumia and Ozone. We also assumed overpriced e-commerce names so short. We were shorting retail apocalypse, so Under Armour, Ralph Lauren, Gap, PVH, Capri, Tapestry. We were also thinking that airlines and the industry will take a longer time to recover. So far, we are wrong here, as revenge spending did take place. But I think that nowadays with the recession playbook, we will be correct on those shorts. So we're actually looking. We are shorting some of these hotels, actually also including Airbnb. So we're actually shorting also Airbnb nowadays. So shorting these names. We have been correct with the shorts on hotels. Sorry, shorts on the ghost offices. We were wrong here on the energy names. In March 2021, we were thinking that Chevron and ExxonMobil would be the direct opposite of sustainable energy. We are wrong there. We were correct with the NFT hype to short that for Funko. And then extended casinos, we are also shorting. Currently, we're still shorting casinos. Yeah, so let me share to you a few of our big ideas. Let's share to you the big ideas. So top positions as of March 2023. All right. So we have Coinbase puts and bear spreads. We believe that the Coinbase stock crypto exchange is going to continue to suffer it's going to suffer losses mainly because revenues are down. It's been down 80% already and is forecasted to continue falling in terms of lower interest with cryptocurrency. So the exchange will have less fees to earn. And take note that all these regulations and securities will lead to more penalties. Therefore, income-wise, Coinbase will have a problem. Layoffs are already huge, and stock-based compensation expenses are also huge for Coinbase. Sharing, which tells us that Coinbase, on a revenue and an income basis, is a good short. Continue shorting. We have Coinbase puts. We've got Coinbase bear spreads. We also believe that gold miners like NEM will be a consistent dividend payer for the year, with gold prices rallying. For NEM, Newmont Corp, every $100 increase in gold is a $400 million free cash flow for the company, which will be included in their dividends. Therefore, we think that NEM at about 45, 46 is a buy. So we actually have NEM bull calls here. I think it's going to hit 55 within the next couple of months until June. We have the buy on NEM through NEM bull spreads. As I said, we're shorting footwear, apparel, and athletic leisure. So we're shorting Burlington. We're shorting Nike. We're shorting Foot Locker. We're shorting a lot of apparel and clothing. Yeah, so we're shorting a lot of consumption-related spending. Berkshire puts, yes, because we believe that the bank sector, like Bank of America, is going to continue to fall. We think that there will be further losses ahead with the commercial real estate loan books going to show outsized credit losses. Therefore, Berkshire puts, SPY shorts. For DraftKings, it's still a short. We believe that casinos as a whole are still going to continue declining, as casinos are consumer discretionary spending that is not fit on a recession. So retail weaknesses are evident, not just in the US, but actually also in global retail outlets like Minisaw. So retail weakness, we think, can be done through Minisaw shorts. Casino weakness, we think that could be done through Wynn, MGM, and Las Vegas Sands. We have shorts on them, bearish puts made. QQQ is overstretched, hence we are also making bearish puts on big tech, even if everyone believes that big tech is safe, because big tech today is very, very expensive as a whole. It's actually trading as much as similar to the year 2000 NASDAQ bubble. And that means that during the NASDAQ bubble, most of the big tech fell 80% down from its peak. Now, we're not saying that the QQQ will fall 80%, but we think that it could fall 10 to 20% from here. So we also see Apple toppish, declining revenues, and they're actually now trying to diversify. But we think that those diversification towards those Apple movies isn't actually going to help anything to offset the demand drop in iPhones. So Melly is a short as well. E-commerce, not just the overstretched ones in the US, but also in Latin America. Mercado Libre is a short here. You've got travel. We're bearish on all of them. Airbnb, Booking, Trip.com, whether it be China or the world. Basically, we're also bearish on China real estate and we do it through real estate services platform like Becky. As I said, we're bearish on China on real estate services like Jones Lang LaSalle and CBRE. not here, but we're short on them. Our view is short on them. We are also of the view that AI narrative is a big hype play. We took a look that Nvidia's forecasted sales on ChatGPT is just $1 billion. Currently, Nvidia is trading at about 700 billion, $650 billion market cap. It's actually added around 350 billion. It doubled already in just a month and a half, from 140 to 280. So we think that in the next 3 months or 6 months, Nvidia bears will be rewarded pretty much. So we have shorts on the semiconductor ETF through inverse funds like SOXS, direct shorts on Nvidia, NVDS, and then direct shorts on NVIDIA and VDL. So both the long side, we're shorting or going long the inverse funds. For consumer discretionary, we're shorting Tesla, Airbnb. Auto loans are now over 14% interest rates. It would be very difficult to buy a Tesla or any other car out in the market with very high interest rates. You might see more delinquencies, and so very difficult for demand to ramp up even if you have price decreases. Also, we're probing shorts on some Chinese reopening spending through Yum China and actually through Haidi Lao. I think that's also a short, and then a short also on all the casinos in Macau. So yeah, that would be our ideas for the next 2 to 3 months. We think that earnings season is coming this April, and earnings season will reveal quite a lot of skeletons, mostly in the financial sector. And that would actually bring about further losses in the Dow Jones, the SPY, and the QQQ. So hope that you are prepared for recessionary playbook in your portfolios, and be ready for more drops. That's what we think. All right. So good night and have a good day. Good night, good day, whatever, wherever you are. And thank you for subscribing, liking the Awesome10X channel. Please follow me on Faces Trader. My Twitter handle is @Faces Trader. And looking forward to having some of you guys as members if you ever want to learn from us and, just trade the markets with us. Thank you very much. That's it. Bye-bye.